Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. The Canadian non-registered investments in brokerage accounts, real estate rental investments, etc. have a special power in that you can write capital losses off against capital gains to pay less or no tax for the assets you sold and that made you money. The selling of losing assets is called tax loss selling and is based on the notion that the asset is worth whatever the market thinks it's worth, and that you should ignore the fact that you are negative on the asset and use the loss as a tax advantage. If you don't think the investment will recover, you should sell it in any case. If you think it will recover, not just hoping that you'll get back to break even, you may wish to sell it now, harvest the capital loss, and buy a similar investment immediately, or buy the same investment in 30 days, and worry about the taxes on the appreciation later when it goes up. I'll discuss superficial loss rules and the 30 days in a second. So tax loss selling usually takes place at year end, so December is the season for it. It happens when an investor knows his or her net taxable capital gains for the year are positive. Capital losses realized during the year offset capital gains realized during the year for a net capital gain or loss. A net capital gain is taxable in the year. A net capital loss may be carried back 3 years or forward indefinitely to apply against net capital gains. Let's talk about the superficial loss rules. If you sell a security to trigger a loss and you or an affiliated person, for example, your spouse, corporation you control, or a trust where you have major beneficial interest, including an RRSP, purchases an identical security within 30 calendar days before or after the sale date, and that person still owns that security 30 calendar days after the sale date, then the capital loss is denied to you and added to the cost base of the person who bought it. This rule also applies if you or the affiliated person buys an option or a right to buy the security that was sold. Please note that the capital loss will be denied if the buyer of the property is an RRSP under which the seller or seller's spouse or common law partner is the annuitant. Therefore, swapping or contributing eligible securities to an RRSP will result in the denial of a capital loss, even though accrued capital gains would be taxable. Through tax loss selling, you are not at a complete disadvantage if you sell assets that generate capital losses. Even they have their uses. So if you'd like to save some taxes for 2021, consider cleaning out your portfolio's duds and get a tax credit against capital gains from them. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.